Welcome to vTalkInsight, Market Drivers Daily for June 11th, 2026. Today, the AI, Capex, supercycle, Middle East tensions, and an assertive European central bank are pulling markets in competing directions. Let's unpack how that tug-of-war is reshaping the balance between equities and rates. AI remains the dominant macro and equity story, but the tone has shifted from uncritical enthusiasm to hard questions about capital intensity, power, and regulation. The Capex numbers are now staggering, with estimates of AI and grid spending reaching up to around $1.4 to $2 trillion a year over the next 5 years. Hyperscaler AI infrastructure spending is reported up roughly 30% in the first half, and about half of that increase reflects higher prices rather than just more volume. This is turning the AI build-out into a major macro driver for growth, inflation, and funding needs. Behind those big dollar figures, physical constraints are now front and center. Power supply is emerging as the primary gating issue for new data center build-outs, which is why partnerships with major generators like Vistra and grid-independent platforms are so heavily emphasized. Vista is targeting around 250 megawatts of dedicated AI inference capacity next year, while Digital Bridge highlights more than 32 gigawatts of compute-ready power globally. The industry is also talking about self-improving AI systems with massive energy needs, reinforcing the view that access to cheap, reliable electricity will be a defining competitive edge. Equity markets are no longer rewarding AI spending on headlines alone. Oracle's plan for roughly $70 billion of AI data center capex and a potential 100% capex to sales ratio has triggered sharp share price declines, despite strong AI demand signals and higher revenue run rates. We're seeing a clear narrative shift. Earlier in the cycle, aggressive capex by hyperscalers and server makers fueled rallies. Now similar announcements are drawing criticism over margins, execution risk, and delayed revenue upgrades. Investors are demanding workflow-specific, cost-transparent AI solutions, not just generic intelligence, and they're scrutinizing whether high capex is justified by future cash flows. On the demand side, AI agents are spreading quickly, but realized returns are still patchy. A majority of surveyed organizations report using agentic AI, yet only a small single-digit share see clear, measurable business returns, as many C-suites remain wary of handing core workflows to autonomous systems. There are bright spots. ServiceNow highlights case deflection rates as high as 90% when AI is layered on redesigned processes, and sectors like hospitality are using AI to automate back-office tasks and redeploy staff to guest-facing roles. That helps explain why the labor market remains resilient, with AI currently augmenting and reshaping jobs rather than triggering broad layoffs. Policy and regulation now add another layer of uncertainty. Prominent AI leaders are explicitly welcoming government authority to block risky model releases. Public concern over job losses and higher electricity bills is high, and U.S. policymakers are even debating windfall taxes or state equity stakes in AI platforms. At the same time, the industry looks set to bifurcate between a handful of capital-rich players controlling advanced models, power, and chips, and a long tail of commoditized providers facing price deflation and margin pressure. Upcoming mega IPOs, including the SpaceX listing positioned as a data and AI infrastructure play, will be important tests of how much new equity supply markets can absorb. Many of these AI and power themes flow directly into today's geopolitical and energy story. Geopolitical risk remains anchored in the Middle East, where escalating U.S. and Iran hostilities, renewed strikes, and threats against key oil hubs have undermined confidence in the latest ceasefire efforts. The Strait of Hormuz is effectively constrained, with tanker and LNG flows sharply reduced and many vessels operating covertly with transponders off. U.S. escorts have still enabled close to 200 tankers carrying over 100 million barrels to pass since the ceasefire. But shipping data are unreliable and the true scale of flows is hard to judge. That opacity itself is a source of risk, particularly with oil inventories described as critically low. Despite these tensions, spot oil behavior has been surprisingly muted. Brent has traded around the low $90 area, even after reports of missile strikes and threats to seize strategic islands, and has at times fallen 1 to 3% on headlines suggesting possible deals or memoranda of understanding. Markets appear to be discounting an immediate, large-scale supply shock, helped by factors like reduced Chinese imports and rerouted flows. Some base cases even see de-escalation leading to Hormuz reopening and oil drifting back toward the mid-70s by year-end, although that is far from guaranteed. Oil and gas executives are much less relaxed than the price action might suggest. They warn that inventories are near critical lows, and that a sustained move to triple-digit crude or gasoline above around $4.50 per gallon would strain the economy and could threaten the current bull market. The conflict is also disrupting supply chains for industrial inputs like helium and sulfur, and risk premia remain embedded in freight and insurance costs. In other words, the shock may be less about today's spot price and more about the vulnerability to a nonlinear spike if negotiations fail or a new incident hits key infrastructure. Energy-dependent regions, particularly parts of Europe and Asia, are bearing more of the macro strain from higher fuel and shipping costs. European airlines with strong fuel hedges and efficient fleets are weathering conditions better, while less hedged carriers face margin pressure, capacity cuts into winter, and potential consolidation. Hotels and other travel-linked sectors are also exposed, with energy accounting for a mid-single-digit share of operating costs and many firms protected only temporarily by hedges that roll off in coming years. Over time, ongoing instability around Hormuz is likely to push Asian and European buyers toward longer-term contracts for U.S. crude, reinforcing demand for U.S. exports. Market pricing reflects both relief and caution. Equities have staged sharp risk on moves on any hint of a deal, with the S&P 500 rallying nearly 2% on one reported memorandum of understanding, while at the same time investors bought treasuries and sold oil, signaling skepticism about how durable those headlines are. The front end of the treasury curve has risen about 75 basis points since the Iran conflict began, and producer price data show energy-driven inflation reaccelerating. That tight link between geopolitics, oil, and inflation feeds directly into central bank reaction functions, setting the stage for a higher-for-longer rates discussion. Monetary policy is reinforcing the higher-for-longer narrative, with the European Central Bank now tightening into a fragile growth backdrop. The ECB has raised all three key interest rates by 25 basis points, its first hike since 2023, explicitly citing persistent inflation pressures linked to energy and the Iran conflict. Updated projections show euro area inflation staying above the 2% target until at least late 2027, and the 2026 forecast has been revised up from about 2.6 to 3%. Core inflation is accelerating faster than headline, despite recent PMI data pointing to a notable slowdown and a small contraction in GDP last quarter. Officials emphasize that this move is not a mere insurance hike. They argue failing to act now would be riskier than tightening into soft data, especially given renewed energy shocks. At the same time, communication is deliberately cautious, stressing a meeting-by-meeting, data-dependent approach and avoiding firm forward guidance on the terminal rate. Market pricing is already highly hawkish, with roughly 70 basis points of additional hikes seen this year and debate over a possible third increase. That leaves limited room for upside surprise on rates unless inflation or oil reaccelerate meaningfully from here. Outside observers are more divided. Some argue that raising rates into a contracting economy and largely supply-driven inflation risks repeating past policy mistakes, highlighting the experience of 2008 and 2011 when ECB hikes coincided with peaks in oil and inflation. Stagflation worries are also resurfacing as rising jobless claims coincide with the fastest producer price increases since 2022 and stubbornly high energy costs. For Europe in particular, dependence on imported energy and exposure to Middle East shocks magnify the downside growth risk if policy proves too restrictive. In the U.S., two-year Treasury yields have moved above 4% and are expected to remain elevated, with markets pricing roughly 40 basis points of additional Fed tightening and some scenarios pointing to a 50 basis point hike in the 2026 to 2027 window. Others see the Fed on hold for an extended period, constrained by its dual mandate and a still strong labor market. Central banks more broadly have moved away from the language of transitory inflation, And even smaller institutions, like the European Central Bank, are pivoting hawkish in response to geopolitical and energy-related price pressures. Despite higher yields and a heavy calendar of AI and infrastructure borrowing, credit spreads remain tight and euro area bank lending and corporate bond issuance are still edging higher, suggesting financial conditions have not yet hit a breaking point. The Fed's large balance sheet continues to act as a backstop for liquidity, but there is concern that overly aggressive quantitative tightening could destabilize funding markets. From here, the key watch points are the next round of inflation and wage data, the path of oil prices as Iran headlines evolve, and how far front-end yields push beyond current levels. Together with today's AI and geopolitical dynamics, those factors will shape whether the higher-for-longer regime persists or finally gives way to a clearer pivot. To sum up, the AI investment wave is still building, but markets have shifted from rewarding any Capex to demanding clear returns, reliable power, and credible regulation. In parallel, Middle East tensions keep an embedded energy risk premium, even as spot oil prices move sharply with each ceasefire headline. The ECB's latest hike into weak European data underlines a higher-for-longer policy stance, while front-end U.S. yields above 4% show that inflation and oil remain critical swing variables for rates and risk assets. Monitoring AI, Capex discipline, shipping flows around Hormuz, and incoming inflation prints will be key for navigating this environment. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.